As of 11:35 a.m. Eastern Time on Thursday, January 15, 2026, Goldman Sachs stock is trading at $970.13, marking a significant intraday jump of $37.46, or roughly 4.02%. This sharp upward move comes on a day when the broader financial sector is feeling the weight of a complex earnings season, yet Goldman is separating itself from the pack in a way that few expected. If you were looking at the top-line numbers alone this morning, you might have been tempted to hit the sell button. Total revenue actually fell by 3% compared to last year, coming in at $13.45 billion. Usually, a revenue miss of that magnitude for a Tier 1 investment bank would send shares into a tailspin, but the reality beneath that surface-level data is far more compelling. The market isn't punishing Goldman for that revenue dip because it understands the dip was almost entirely driven by a strategic exit from the Apple Card partnership, involving a massive $2.26 billion markdown. Investors are cheering because once you strip away that legacy baggage, the core engine of the firm is running hotter than it has in nearly half a decade. The tension here lies in the expectation that Goldman Sachs would struggle to find its footing after a messy divorce from its consumer banking ambitions. For years, the narrative was that Goldman had lost its way, trying to compete with retail giants and digital-first players like the Robinhood app or the SoFi trading platform. The reality we are seeing today is a bank that has successfully returned to its roots as the undisputed leader of global deal-making. While retail investors might be looking for investment help on investing sites to figure out if they should be holding Apple stock or Nvidia stock, the institutional heavyweights are looking at Goldman's 25% surge in investment banking fees. The firm advised on over $1.4 trillion in deal volume last year, and today's price action reflects a market that finally believes the deal-making renaissance is here to stay. This is a massive shift in sentiment from just 6 months ago when many feared that high interest rates would keep the M&A market frozen indefinitely. When we look at the daily swings we're seeing right now, the volume is notably higher than the 30-day average, suggesting that institutional money is rotating back into the stock. This isn't just retail enthusiasm on a Robinhood stock trading account. This is big block activity. Traders are reacting to the fact that Goldman's equities desk raked in $4.31 billion this quarter, easily beating the consensus. The volatility in the currency and commodity markets has provided a perfect backdrop for Goldman's fixed income traders to outperform, and the 16% return on equity they posted this quarter is a loud statement to the rest of Wall Street. It's interesting to compare this to some of the other players in the space. While Interactive Brokers stock trading remains a favorite for high-frequency individual traders, Goldman is proving that for the massive multi-billion-dollar corporate mergers, they are still the first call. Speaking of individual brokerage choices, it is fascinating to see how the landscape of online investing has shifted the way people view these banking giants. Many younger investors who started with a SoFi active investing account or used Schwab Intelligent Portfolios are now graduating into more complex strategies, and Goldman is trying to capture that wealth through its asset and wealth management division. That segment now accounts for a massive chunk of their fee-based revenue, providing a stabilizer for the more volatile trading and banking arms. If you look at how Fidelity Investments or the Fidelity mobile app have democratized access to Fidelity mutual funds, you can see the pressure on Goldman to make their own wealth management services more accessible. They've realized they don't need to be a retail bank for everyone, but they do need to be the premier wealth manager for the affluent, a strategy that is clearly paying off in the latest report. The macroeconomic pressure of the last year has been a double-edged sword for Goldman Sachs stock. On one hand, the higher-for-longer interest rate environment made it expensive for companies to borrow for acquisitions. On the other, the anticipated Fed rate cuts in 2026 are creating a front-running effect where CEOs are finally pulling the trigger on long-delayed mergers. Goldman CEO David Solomon mentioned this morning that the firm sees a flywheel of activity accelerating. This is is a classic example of expectations versus reality. The expectation was a slow, grinding recovery. The reality is a sudden, sharp burst of activity as companies try to secure their positions before the next economic cycle fully takes hold. If you're a long-term holder, comment below how many shares of Goldman Sachs you currently hold and what your price target is for the end of 2026. Beyond the immediate trading numbers, we have to look at what this company actually does to understand why a $970 price tag makes sense to some and looks expensive to others. At its core, Goldman Sachs is a service provider to the world's largest corporations, governments, and ultra-high net worth individuals. They aren't trying to be an online investment hub for the masses in the way that a Robinhood crypto or SoFi ETF strategy might be. Instead, they operate through two main pillars: global banking and markets, and asset and wealth management. The first pillar is where they make their name, advising on IPOs, debt underwriting, and high-stakes trading. The second pillar is where they are building their moat by managing trillions of dollars for clients who want more than just a self-investing app. They want the intellectual capital that a firm like Goldman provides. This shift back to basics, away from the Marcus consumer brand and toward institutional excellence, is the single most important driver of the stock's recent 52-week high. If we look at the competition, the contrast is stark. Morgan Stanley has done an incredible job building a wealth management powerhouse, often seen as a more stable, less racy version of Goldman. However, in a bull market for deal-making, Goldman's higher beta and leverage to the investment banking cycle usually allow it to outperform. We are seeing that today as the stock nears the $1,000 mark. Even the big players in the digital space, like Interactive Brokers or the various SoFi stock investing products, don't compete for the same pool of capital that Goldman does. Goldman's reality is that it is a systemic piece of the global financial plumbing. When a company like Alphabet or a massive tech giant wants to make a $30 billion acquisition, they aren't using an individual brokerage or a robo-advisor. They are calling the team at 200 West Street. Looking forward into the rest of 2026, the catalysts are lining up in a way that suggests this move might not just be a one-day wonder. We have a tailwind from a friendlier regulatory environment that is expected to be less hostile toward large-scale mergers. This is a huge deal for Goldman. If the deal desert of the last 2 years is truly over, the sheer volume of backlogged transactions could fuel earnings beats for several quarters. Additionally, the move to transfer the Apple Card business to JP Morgan Chase is a massive relief for the balance sheet. It allows Goldman to stop worrying about credit card loss provisions, which, to be fair, were actually reduced this quarter, and focus entirely on high-margin capital markets work. This is the reality that is currently exceeding the market's expectations. Investors expected a long, painful exit from consumer banking. Instead, Goldman has ripped the Band-Aid off and is already moving on. There are, of course, risks that could derail this momentum. If inflation proves stickier than the Fed expects and the anticipated rate cuts are pushed back into late 2026 or 2027, the M&A market could freeze up again. Furthermore, the volatility that helps the trading desk can also be a double-edged sword if it turns into a full-scale market panic. While the Fidelity trading platform and SoFi stocks have seen record engagement recently, a sudden downturn would hit the asset management fees that Goldman is so heavily relying on for stability. There's also the political risk. While some expect a lighter touch from regulators, election year uncertainty can often cause corporate boards to pause major strategic moves until they have more clarity on the tax and trade landscape. This tension between the sturdy 2.8% global growth forecast and the potential for a fragile labor market is something every investor should be watching closely. To summarize the situation, Goldman Sachs is currently navigating a pivot that has redefined its identity for the back half of this decade. The intraday move to $970.13 is a validation of the back-to-basics strategy. The revenue drop that would have normally spooked the market was correctly identified as a one-time structural cleanup related to the Apple partnership. By shedding the weight of a consumer business that never quite fit its culture, Goldman has liberated its capital to do what it does best: dominate Wall Street. The expectation was that the bank would be hampered by its past mistakes. The reality is that it has used those mistakes as a catalyst to sharpen its focus. For those of you managing your own portfolios, whether you're using Fidelity Wealth Management, Interactive Brokers Fees Analysis, or just a simple Robinhood app, the lesson here is about looking past the headline. A 3% revenue decline looks bad on a screen, but a 25% jump in investment banking fees tells the real story of where the economy is headed. Goldman is often a leading indicator for the health of corporate America. If they're busy, it means the big players are confident. If you're looking for investment help or searching for the best investing sites, keep a close eye on the institutional banks. They often see the trends months before they hit the retail platforms. As we close out this analysis, the central insight is clear. Goldman Sachs has successfully transitioned from a period of strategic confusion to one of high-conviction execution. The contrast between the expected top-line struggle and the reality of their core profitability is what is driving this current rally toward the $1,000 level. They have managed to maintain a disciplined risk framework while simultaneously capturing the lion's share of a rebounding M&A market. Whether you're a fan of the firm or a critic of its